Discount. Fund on sale. Closed-end funds trading at a discount to their liquidating value look like screaming buys. A few are. Most of them are best avoided. A closed-end investment company is a peculiar beast. Unlike funds that are open-end or exchange-traded, a closed-end does not have any mechanism for liquidating the holdings of departing customers. Its shares trade in the second-hand market, with prices, set by supply and demand, that can veer far away from their asset value. A fund selling with a 15% off sticker is not the same sort of thing as a discounted kitchen appliance. If you were prepared to buy the dishwasher at full price, a 15% sale is money in the bank. Not so with a fund. Availability of a discount on it doesn't leave you better off unless something happens to turn the fund's portfolio into cash for you. That could be a liquidation of the fund, an uncommon occurrence, or else a payout from the fund. It might seem that the discount, all by itself, would magnify your returns. It doesn't. Suppose a fund is trading at a 15% discount to its net assets. Then, for every $85 you invest, you have $100 going to work for you in the market. Alas, that doesn't enhance your return. If the fund's portfolio doubles in value, each $100 inside it goes up to $200, but you don't come out $100 ahead. If the discount stays put, your $85 grows to $170, and you have the very same 100% return you would have had if there were never a discount. Sometimes fund discounts narrow. Sometimes they widen. A neutral assumption in your analysis is that a discount stays put. Most of the closed-end funds out there are trading at discounts. Only a few are genuine bargains. These are the ones that combine a discount with two other things: distributions of cash and reasonable expense ratios. There is, in fact, a simple formula that relates three variables: discount, distribution rate and expense ratio, to tell you when a closed end is worth a look. Here's what comes out when the formula is cranked into a database of closed ends available from YCharts, an online investor resource. The screen counted only the 421 funds with at least $50 million in net assets. What all these funds have in common: a negative cost of ownership. In effect, you are being paid to let someone select securities for your portfolio. How does that formula work? Let's go back to our hypothetical fund worth $100 a share but available at a price of $85. Suppose that the fund makes annual cash distributions equal to 10% of the fund's asset value. Every $10 check you get in the mail is something you bought for $8.50. So you have an instant $1.50 gain. Now suppose that the fund runs up annual overhead of 1%. That's $1 out of your pocket. But then there's the $1.50 windfall more than offsetting the expenses. The annual holding cost of a share with a net asset value of $100 is negative 50 cents. Your effective expense ratio is minus 0.5%.